One missing letter helped interrupt one of the largest bank robberies ever attempted. In February 2016, a payment instruction left the Central Bank of Bangladesh and traveled toward an account in Sri Lanka. It looked official. It had passed through the same trusted messaging system used by banks around the world. The amount was $20 million, but the recipient's name contained a mistake. The word foundation had been written as foundation. That error helped trigger a question. The question helped stop the transfer. And behind it, banks began to discover something much larger. Attackers had attempted to move approximately $951 million from Bangladesh Bank's account in New York. Most of the instructions were stopped, but $81 million had already escaped. This was not simply a story about a careless hacker. It was a robbery built from trusted computers, authentic-looking messages, weekends in 3 countries, and a financial system in which every institution could see only one part of the crime. Bangladesh Bank, like other central banks, held dollar reserves at the Federal Reserve Bank of New York. Moving those reserves did not require trucks, vault drills, or physical currency. It required instructions. Banks use SWIFT to exchange standardized, authenticated financial messages. SWIFT does not carry money in the way a truck carries cash. It carries the instructions that tell institutions where money should move. That distinction is essential. The attackers did not need to break into the New York Fed and rewrite its balances. They needed Bangladesh Bank's payment instructions to look real when they arrived. According to the United States Department of Justice, the attackers compromised computers inside Bangladesh Bank that interfaced with its SWIFT environment. From those computers, they could construct and authenticate fraudulent messages that appeared to originate from the bank itself. To the next institution in the chain, the messages did not look like an outsider demanding money. They looked like a customer bank using its own authorized channel. The system was doing exactly what trusted instructions told it to do. The robbery began long before the money moved. U.S. investigators found evidence of reconnaissance against Bangladeshi banks as early as 2014. In January and February 2015, spear phishing messages were sent to Bangladesh Bank employees. The emails appeared to come from a job applicant and included a link to a resume. At least 3 bank computers attempted to download the file. That opening gave the attackers time. They moved through the network, installed backdoors, studied the payment environment, and eventually reached the system at the center of Bangladesh Bank's SWIFT processing. This was not a smash-and-grab intrusion. It was preparation. The attackers learned not only how to send a message, but how the bank would discover that a message had been sent. The local environment normally produced confirmations and stored records in a database. Those records were the institution's memory, so the attackers targeted the memory. Investigators described malware designed to interfere with document confirmations, manipulate local records, and delete evidence. A fraudulent payment could leave the bank while the systems meant to reveal it were being blinded. The goal was not merely to issue orders, it was to create a period in which the orders looked legitimate to the outside world and almost invisible to the people inside the bank. Security systems often imagine an attacker as someone outside a wall. But once an attacker controls a trusted workstation, valid credentials, and the software that produces payment messages, the wall becomes less useful. The dangerous instruction now begins inside the perimeter. That is what made the Bangladesh Bank attack so powerful. The core SWIFT network was not described as breached. The attackers compromised the bank's own environment connected to it. They exploited the difference between securing a global messaging network and securing every computer allowed to create a message. Each participant saw a different fragment. Bangladesh Bank saw local systems that appeared quiet. The New York Fed received authenticated-looking instructions. Correspondent banks saw payments moving toward named beneficiaries. Banks in the Philippines and Sri Lanka saw incoming transfers. No single screen displayed the complete story. A central bank under remote control, false recipients waiting abroad, and malware erasing the evidence behind the orders. On February 4, 2016, the attackers began sending payment instructions. The timing created a chain of delays. It was Thursday in New York. In Bangladesh, the weekend falls on Friday and Saturday. In the Philippines, banks were approaching Lunar New Year closures. When questions began traveling backward through the chain, the people who could answer them were not all at work at the same time. According to a later U.S. indictment, the fraudulent instructions attempted to transfer approximately $951 million. The volume and destinations caused many requests to be stopped or held for review. But 5 major instructions initially progressed, 4 totaling approximately $81 million toward accounts in the Philippines and 1 for $20 million toward Sri Lanka. The Philippine accounts had been opened months earlier under fictitious identities. They had waited quietly. Now, the money arrived. The heist was no longer malware inside a bank. It had become a race across institutions, jurisdictions, and business hours. The Sri Lankan instruction named an intended recipient, Shalika Foundation, but the payment message spelled the word as Foundation. That discrepancy helped prompt an intermediary bank to seek clarification. The $20 million transfer was stopped before the intended recipient received the money. The typo became the perfect headline. One letter saving hundreds of millions. But that version is too simple. The error helped expose one suspicious instruction. Other payment requests were also blocked by reviews, compliance questions, and the unusual nature of the transactions. The attackers had not placed the entire $951 million inside a single transfer waiting for a spell checker. The more important lesson is that a tiny inconsistency succeeded where larger systems had failed. The payment was authenticated. The message format was valid. The sending environment was trusted. Yet a human-readable mistake created friction. Someone paused. Someone asked a question. And in a system designed for speed, that pause became a security control. The 4 transfers to the Philippines had already succeeded. Approximately $81 million entered accounts created under fictitious names. From there, the funds moved through a remittance business and into casino-related channels. This transformation mattered. Inside the central banking system, the money had a clear origin and destination. Inside commercial accounts, it could still be traced through records. But after conversion, cash delivery, casino chips, gambling activity, and junket operations, the trail became harder to follow. At the time, Philippine casinos were not covered in the same way as banks under the country's anti-money laundering framework. The money had reached a gap between systems. The technical intrusion had been designed around exactly this kind of institutional handoff. The attackers did not need every part of the financial system to be weak. They needed a path where each part trusted the previous one, and where the final destination could rapidly change the money's form. Once that happened, stopping the original message was no longer enough. Philippine Senate hearings reconstructed portions of the laundering chain. Money moved through false bank accounts, was converted and remitted, and reached casino junket operations. Witnesses disputed who received particular deliveries, and how much remained recoverable. Portions were eventually returned, but much of the $81 million was not immediately recovered. The scandal exposed a regulatory blind spot. Lawmakers subsequently moved to bring casinos within the country's anti-money laundering rules. This is where the story stops looking like a conventional cyber attack. The malware mattered, the stolen credentials mattered, the false SWIFT messages mattered. But the robbery became successful only when code connected to banking procedure, time zones, account opening controls, correspondent relationships, remittance channels, casino regulation, and human response. Every layer contributed either speed or delay. For the attackers, the ideal system was one that moved money quickly and moved questions slowly. U.S. prosecutors later charged North Korean regime-backed programmers in connection with a broader campaign that included the Bangladesh bank theft, the Sony Pictures attack, WannaCry ransomware, and attempts against other financial institutions. Investigators connected the operations through infrastructure, accounts, malware techniques, and forensic evidence found across multiple victims. SWIFT responded by launching its customer security program. The initiative emphasized stronger security requirements for customer environments, improved information sharing, transaction pattern detection, and better defenses across the banking community. The response recognized an uncomfortable fact. A global financial network can protect its central infrastructure and still remain exposed through the institutions connected to it. Trust is distributed, so security has to be distributed as well. The Bangladesh bank robbery is often remembered as the billion-dollar theft stopped by a typo. But the typo is only the doorway into the story. The system beneath the heist was built from 5 conditions. Attackers had time to study the bank. They reached computers authorized to create trusted instructions. They interfered with the records that should have revealed those instructions. They exploited gaps in working days and response times across countries, and they routed the money toward a place where financial value could rapidly change form. No single failure explains the loss. The lesson is not that banks need better spelling. It is that high-speed systems require deliberate friction, independent confirmation, behavioral limits, rapid alerts, protected records, and people empowered to stop a transaction even when the message appears authentic. Because sometimes the most dangerous command in a secure network is not the one that looks suspicious. It is the one the system has been trained to trust. And in February 2016, one missing letter was enough to make that trust hesitate.